Did you know there is such a thing as good debt? We seem to be ingrained from an early age to save, and not get in debt. But some debt is in fact good and can help your credit score. So, what is good debt? Good debt is important to have so you are able to get the items you want later in life, like a nice car or house. And having good debt to help establish your credit is important. Keep in mind, any type of credit you open will appear on your credit report. When building credit, everyone has to start somewhere. Most department store or gas cards are more easily approved for those with little or no credit history, but it's still important to be careful with your spending on these cards. Even though you may only be able to use these at certain places, it is still debt and can harm you if you use it too much or don't pay it off in time. These do typically come with higher interest rates, but work well if you plan to pay off your balance each month. A secured credit card is a card backed by a deposit, which is used as collateral. For example, if you apply for a secured credit card with a limit of $500, you would need to have $500 in a separate designated savings account as long as you kept the secured card open. If you use the secured credit card, you would still make your monthly payment and it would not come out of the $500 deposit. Another way to help establish credit is to open a joint owner credit card with someone who already has established credit. This can be anyone, but it's typically best practice to do this with someone in your household or immediate family. With joint owner credit cards, both owners use the same credit card account for purchases, but both would also be responsible for making payments on the account. If a payment is missed, it could show negatively on both credit reports. A personal line of credit is a designated amount of credit that you are approved for, and it's typically linked to your checking account for easy withdrawal. If you are approved for a $2,000 personal line of credit but only need to use $500, don't worry. You can use as little or as much of your personal line of credit as you need when you need it. After you transfer the money to use it, you make payments on only what you transferred from your personal line of credit. Student loans are payments you make, typically monthly, after you complete your education. Most student loan companies give a grace period of 6 months before your first payment is due. Most are tax deductible and interest rate is usually lower. Student loans are a good way for young adults to establish some credit and show they are accountable. How much debt is too much? Creditors look at your utilization ratio to determine your credit score. Your utilization ratio is the amount of outstanding balances on any revolving debt you have open, including credit cards and lines of credit, divided by the total amount of credit you have available on those cards or lines of credit. Creditors like to see this ratio at 30% or less. No matter what kind of debt you have, being accountable, dependable, and consistent with your payments, income, and work history are key to establishing your credit. Missing payments, no matter the reason, is never a good idea and can quickly negatively affect your credit. Even if you can only pay the minimum payment due, that is much better for your credit than missing a payment altogether. As always, if you have any questions about establishing credit, call Founders at 1-800-845-1614 and a Founders representative can help review your financial situation and find a better solution that is best for you. Not a Founders member? Visit RelaxJoinFounders.com to see if you qualify for membership. Relax with Founders Federal Credit Union.